Hello, everybody, and welcome to this week's NASDAQ Dorsey Wright podcast. My name is Will Gibson, one of the research analysts here at NASDAQ Dorsey Wright. And this week we have a special guest, John Lewis. He's one of the portfolio managers for us out in California. And today, our main conversation is going to orbit around the momentum factor as a whole. We saw it be really the worst performing factor in 2021. Really, no matter how you measure it, no matter how you're accessing that trend following component, it was not a great year for trend following strategies. So John is going to come on and share some of his perspective on that. And then we're also going to talk about how we are currently set up on the momentum landscape, some things that are looking promising. Kind of January as a whole has gotten off to a pretty choppy start here, especially for some of the momentum strategies. So we're going to add some perspective around that and then conclude with some maybe more forward-looking thoughts about how we're set up for the rest of the year from a trend following perspective. So John, just to kind of open up the floor here, we were talking before we started recording that looking at last year, 2021, trend following strategies struggled as a whole, whether you're using relative strength to access that trend following component, whether you're doing trailing performance, whatever it was very difficult to discern any trend last year, and you saw some material underperformance from that.
Yeah, so I think from like an asset class level, there wasn't a whole lot going on, right? Like U.S. equities like remain number one, which is great for U.S. investors. But then, below the surface, we had commodities moving around and international equities moving around. But from an asset class, like that US equity theme was pretty stable. Then you look under the hood and like that's where the issue started for momentum. And I think the biggest thing is probably to talk about like maybe sectors first. So we saw a tremendous amount of volatility in sectors, stuff going worst to first and back to first, like a lot of stuff was not stable. And so we think about like how good technology has been. Well, I mean, I think people forget that technology, like in our Dolly ranks in like April, May, June, like dropped down to number 6 in the Dolly ranking. So, kind of out of that top half area. Then, now it's back to 1. Energy is another one, right? Like in the end of February, that was the top ranked sector. By August, that was the worst ranked sector, and now it's back up to number 4. So when you have a lot of this back and forth movement like that, it's going to be really tough, like exactly like what you said, for these kind of trend following momentum strategies to do really well, because part of what these momentum strategies do is they rotate around to what's working now. And if what's working now is constantly changing, you're kind of chasing your tail all the time in order to get the best performing stuff in the portfolio. So I think, that kind of instability over the course of the year, even though domestic equities were really good as an asset class, underneath the surface, there was a lot of rotation going on, and that makes it really, really difficult. I think one of the things, I mean, if you want to go back a long way, I think 94 that happened. It might have been a little different, but the indexes kind of did okay. And at some point during the year in 94, like every sector had its own bear market, just like at a different point in time. And so that's the same kind of deal. And it's probably not extreme this last year, because we had really good equity returns. 94, the returns weren't great. But what I'm talking about is kind of that instability in all these sectors kind of moving around at different points. It's just hard to get onto the leadership because it wouldn't continue. And so I think that's really what we saw last year. And that was the crux of the problem for, like trend following and momentum strategies and that sort of thing.
Yeah, I think that makes a lot of sense. And that's an important distinction to make, not just from a broad asset class, because it was a pretty stable trend there, but from that domestic specifically camp, we saw a fair amount of trouble. And talking about all those corrections that you saw for sectors, you saw a lot of volatility pick up, especially as it relates to energy, as you were talking about. Even real estate, it started the year, I believe, in one of the basement rankings of our momentum models or strategies, and it really worked its way up. So you saw some pretty notable laggard rallies, kind of longer term coming into the year. And it was pretty remarkable that you didn't have a bigger market correction. I know I've said this before on other podcasts, and we've put in our report that it's pretty incredible that you didn't have the major indexes pull back more than they did. I think the S&P was like around 5% for the year. I think you got a NASDAQ actual correction around 10%, but it was pretty remarkable. All the sector rotation that you didn't see a bigger pullback. And then for momentum as a whole, you guess it was the worst performing in 2021. Last time, at least that I'm looking here, in more recent years was 2016, where you saw momentum really flail around. If you follow our models or strategies, that'll typically be a year that sticks out. But following a year of momentum's underperformance, it typically doesn't follow up with extended periods of underperformance, at least from what we've seen from our studies. And I know, John, you've talked about this in presentations. One call kind of more to factor, more to consider, is that momentum is not growth. That's something that we get questions about a lot. People assume momentum and growth are synonymous. And while momentum can own growth, momentum can also own value. Momentum can also own quality or other factors that are working in the markets and avoiding the others. So as we're starting 2022 here, it may be a more aggressive call, but we wouldn't expect momentum to continue to underperform. And I know, John, you have some thoughts on that as well.
Yeah, I mean, momentum, the interesting thing is it's a self-correcting mechanism, right? So it's going to go and find what's working. And that was the problem last year, right? Because what was working then stopped working and then started working again. But that's kind of actually the strength of momentum, right? You don't just get painted into a corner and have to stay there. And we put some graphs together a while ago. And we showed like what happened with a momentum index in terms of underperformance and drawdowns. And then we also looked at like growth and value, right? So I think most investors are really familiar with that kind of growth value distinction and style boxes and that sort of thing. And what we found when you see it graphically, I think it's pretty clear, like momentum has these periods of underperformance that are sharper, but the recovery comes much quicker. So if you think about like growth and value, I mean, those things can kind of underperform and just kind of bleed out for years, right? Like value had years where it underperformed, and maybe not by a ton, but I think the problem is that's what investors are conditioned to. That's kind of what the industry is set up for, that paradigm. And then when you get something like momentum that has this like sharp underperformance over 6 months, people kind of don't know what to do with it. But the flip side is like the underperformance causes turnover, and that turnover gets the new leadership in there. So like if you follow what we do, like we had a big turnover year last year because we're constantly trying to find the leadership. That'll probably continue into the first part of 2021 until we get some leadership and we get some direction. And then, you kind of leave the things in place and off it goes. So you're right. Like 2016 wasn't great. And then we came back, momentum really came back in 2017. That was a good year. So we don't really know exactly when it'll come back, but I'll say we're closer to it being the top performing factor today than we were at the beginning of 2021. That's for sure, right? Like you go through these periods and it kind of self-corrects. So it's an interesting phenomenon, and I think it's hard for people to deal with it a lot of times, and that's kind of that emotional part of the business that's really hard. But we know that momentum's super, super good at finding where the leadership is. And last year, like I said, a little too good, right? And so, it'll find it. We're not really worried about that too much.
Yeah, and the factor's been around for forever, for behavioral biases, reason for a slew of other biases, even some like cognitive biases. I would probably argue that kind of contribute to that alpha for the factor. And to kind of dovetail off and actually kind of reiterate what you were saying about how you're expecting momentum to kind of continue to flail a bit in the first parts of 2022, I think is probably what you were meant to say there. And like you said, following 2016, momentum roughly was the second best performing factor that year. 2018, it was roughly the third best performing. And then 2019, 2020, it was the best performing. So maybe 2021 was a bit of a mean reversion from maybe a factor perspective. It was a huge leader for a number of years. So maybe that's something to consider as well when you're thinking about momentum. And then something else that I like to articulate with people, and I know, John, I think we've talked about this as well, is that it's not best to try and time factors. So time when you want to use momentum, or time when you want to use something else, because it's typically time in the factors that really produce that alpha, because you can have these sharp periods of underperformance. If you try to work your way in and out of momentum strategies, I think it's going to prove to be more of a headache than really a benefit for that matter. Like last year, some things that I was watching is that are more sensitive models. So we have models that will update from daily to once a year, but the models that we're updating on a daily or even weekly basis, we're doing much better than your longer dated, less frequently evaluated models. And maybe that continues a bit into this year. That's the trend so far that we've seen in the first week or so. But more often than not, it's the time in the factor, and sticking to that discipline over a number of years is that where you see the benefit, at least from my perspective here.
Yeah, I think that's right. And another important point about that factor stuff is, part of the reason why you separate stuff out into factors is for to lower the standard deviation, right? And you have these returns that come at different times, right? So momentum does really good one year, and then value the next year and whatever. And you have these excess returns that are negatively correlated, right? And that's just like some fancy way for me to say, one's zigging, the other zagging, sort of thing. When you start timing all these strategies, that part of factor investing goes away, right? So if you're only in momentum, you don't get the benefit at the turn of having value in the portfolio. And so then if you're rotating factors, you're just doing a rotation strategy. And then the question really becomes, should I be rotating factors, or maybe I just want to rotate sectors or whatever? Like, is factors the best thing to rotate? I don't know. But there is a give up in that, the overall portfolio volatility when you start rotating factors, right? Like, having stuff in there helps you with the turns. The turns are always going to be a problem for momentum, right? Like, that's always a problem. You can't get away from that. And so, yeah, that's, having that in there is definitely help. And I did want to touch on something you said too about like the daily models versus the longer dated models and things like that. And I think that's true. But we found something, like sometimes when we set up our strategies, and you can do this, like if you're a Dorsey subscriber and you have a matrix, for example, right? You have to figure out where you're going to sell stuff, right? And so you might sell it out of the top quartile, or you might sell it out of the top half. And either one works. And we've had some stuff in some of the broker institutes where we go over, kind of what the difference is and how it looks and stuff like that. And so what we found last year was the higher that you put that threshold, right? So selling out of the top quartile didn't work as well as like selling out of the top half, right? And the reason for that is last year, with all the back and forth in the sectors, right? If you sold something out of the top quartile, you didn't get a chance for it to kind of fall down and then bounce back up and start working again, right? You're churning the strategy more. And I think that's important. I wanted to kind of talk about that a little bit, because I think the number one thing and the number one mistake that people make when they like start running a matrix or start doing these momentum strategies is they want to rotate it as fast as possible. And they think more trading is better all the time. And kind of the common thread you hear when people are talking about that is they want the lag at the turn to be as small as possible. So if they are quicker on the trigger, they think that that's going to help. And then like last year, you see how that doesn't help. Right. So the more you were pushed out on the momentum spectrum, kind of the worse you did. And if we break stuff up into like deciles, right? Like that top decile really struggled. Like the middle deciles did better because they let things kind of move around a little bit more. So that's another thing looking back at 2021 that I think is super interesting. There are definitely years where that happens. And that was one where you don't want to be cutting things out as quickly as possible. You don't want to be as far out there on the momentum spectrum all the time. And when you do like sell out of the top half, like you do have give up in some years, but last year was a perfect example of where that really helped you and kind of helped smooth out the returns over the course of the year.
Yeah, that's really good perspective, and I hope that was well heard, because that's really important. And something anecdotally that I've been hearing is that the velocity of market cycles, or the frequency of them, is perhaps shortening, perhaps moving quicker, whatever it may be. Like you said, momentum is a self-correcting factor, and regardless of kind of where you put that sell discipline, the point holds is that it will self-correct and it will adapt to kind of those changing market conditions. And it's tough to analyze some of these past years because there's probably an anomaly in there, at least one or two. So building strategies to work just in 1 year is probably not going to be a repeatable, efficient investment strategy for a 10 to 15 year period. So that's something that we got a lot. People were saying, oh, I should be following this model because it's doing well this year or over the past 18 months. But we would say, well, look at the past 5 to 10 years or some bigger repeatable investment horizon. So I would kind of tack on that as well. And then maybe, John, just a few other thoughts. So talking specifically about 2022 now, kind of how momentum is set up to hopefully take better advantage of the market this year. January hasn't been great. I know you had a few thoughts about taxes are something to consider when going into January, and even some of the academic studies for momentum, you said also bring this into consideration, right?
Yeah. So January, the kind of January effect, and people have been talking about that for a while. It doesn't happen every year, but I think there's a company called Columbine Capital, a guy, John Brush, ran it. And I think he was the one that I remember doing this the most. I'm sure there's other academic papers out there that do this, but they would run their momentum models, and then they would also look at it X January. Right, because January oftentimes had some big reversions, and it usually comes closer to the very beginning of the year. And I think there's a couple factors that really influence that. Number one is that, if you have a momentum strategy, you're holding the winners, right? You're holding the stuff that has had the best price performance over the last 6 to 12 months or whatever. Well, when you start to get into December, and this is a US phenomenon, right? Because of US tax laws, you don't want to sell those winners, right? If it's December 15th and you've got something that you need to sell and it's up 100% on the year, there's no reason, long-term or short-term gains excluded, there's no reason why you shouldn't push that to the next year and have, another 12 months before you have to pay Uncle Sam, for those gains. So that happens, and people delay selling those big winners until the new year hits. So that's one. Number two, I think, and what we might be seeing some of this year, and this is, I think, super hard to quantify, but like last year, I think it was only the fourth time since 1976 that bonds, as measured by like the Bloomberg aggregate. I think it's the Bloomberg aggregate now. It used to be like the Lehman Ag, then it was the Barclays Ag. So I went through a number of name changes, but anyway, AGG, right? So that was only the fourth time it's had a negative return since 1976. So you think about that, and you think about people with balanced portfolios and all the rebalancing that needs to take place. And again, if you've got a bunch of clients and you are out of whack because bonds didn't have a good year and your equities did, and you've got to kind of sell some equities and buy some more bonds to get them back into square, you're not going to do that at the end of December, right? You're going to push that off into January as well. And so there's got to be a lot of people rebalancing, and just, I don't think that's necessarily a reflection on what they think equities are going to do going forward. It's just they got to get back to 60-40 or wherever they needed to be. And so I think there's some of that going on too. I don't know how long that lasts, and that's super hard to measure, but just, we're in this business, right? Most people listening to this podcast are like managing other people's money. So I'm sure you kind of all get that, how, you got to you got to do some stuff sometimes where you're managing the clients and the portfolios, getting them back in line. And so I think there's probably a lot of that going on right now too.
Yeah, I absolutely agree with that. And thinking about the rest of the year now, you mentioned the January effect. There's also kind of the January barometer that the market would say is that kind of so goes January, so goes the rest of the year. Has a pretty decent batting average. I was reading a Bloomberg article here that since 1950, that January barometer has been right 84.5% of the time, according to the Stock Traders Almanac. So January is up, market at least the following 11 months would also be positive, January being negative, vice versa. So I think it will be really important to watch at least the second half of this year and maybe the first few quarters as we continue to sort out some volatility here, see if we can get a trend to follow for our strategies to latch on to. So that's something to look forward to. I think we're pretty optimistic about that, given that broader term, domestic equities, commodities, very much a risk on posture broadly for those intermediate, longer term investors are at least still in place right now. So hopefully that near term can resolve itself as well. I know we didn't talk about international today, and I don't think we'll have the time to really go into it, but that was actually a pretty positive diverger on the momentum landscape last year, where you did see some notable outperformance from the momentum strategies where those leaders did lead. Laggards really were probably avoiding the laggards. International was probably more of the name of the game last year. And that's something that I think we're also seeing head into this year as well, John, if I'm not mistaken there.
Yeah, so I think on the international side, I think especially like in emerging markets, that was true. Like China was just a big laggard, and we do the Wednesday call where all the analysts kind of come on and go over their different sectors, and it was like every week, Ian's section on international was like a broken record. Like China's at the bottom, this, that, and the other, and that's such a large part of emerging market benchmarks. It's like a third of them or even higher. So, avoiding that, I think, was a big deal last year on the international side, and momentum helped with that. And yeah, I think that's true. Like when you get a big sector of the market like that, you can generate alpha like two ways, right? Like you can own the good stuff and you can just not own the bad stuff, right? Like that was old Alan Shaw thing. He was a technician at Smith Barney, like forever. He was one of the best. And really, really good at what he did. And that was one of his things. Like he would always say, your performance is determined as much by what you own as what you don't own. And so momentum's good at that too. And we do focus on like, hey, what do we want to own? What's working, where the strength is. But just as important is to know like what to avoid. Like if you didn't have utilities and staples last year, like that was pretty good, right? You did okay if you just like avoided a couple of those areas, and like low vol areas and stuff like that were terrible. So yeah, I mean, there were some interesting things, and avoiding the laggards is for sure just as big a part as owning the winners.
Absolutely. Yeah. And then kind of wrapping up here, just a few kind of bigger picture thoughts. I would say I was hearing some commentators the other day, and I haven't heard this said before, but they said it's about surviving a bull market where the market is getting thrown a bunch of worries right now, per usual, in every type of environment. And they said it's almost about surviving a bull market as opposed to people talk about surviving bear markets and preparing for bear markets. And while that is good and admirable, it's more often than not an upward bias of the market that you're going to have to survive bull markets. So not pulling out at wrong times, choosing to raise cash or whatever it may be, kind of making those small incremental portfolio moves as we kind of go along into the rest of the year. And just
I'll
go ahead.
Too, just to follow on with that. Yeah, I mean, I think that's a really good point. If you're investing in equities, you've got to be prepared to like have some drawdowns now and again, right? It's just not all unicorns and rainbows. Like there's some times when the market goes down and you're just going to have to deal with that. And what we found over the years, and I think this is really true, like you can kill yourself with paper cuts if you're not careful. Like if you are too cautious and you're going to raise cash too much, you're not going to let this stuff work. You can get killed with the paper cuts. Like every 5% correction, there's a ton of them. You just kind of have to live with those. And what you're trying to avoid are the train wrecks, right? Like the stuff that's going down 20%. And the problem is, where do you sell? What do you do? We have a bunch of indicators for that, but you're always going to, there's always kind of some level where you're going to want to raise cash and, it's not going to work out and whatever. But those levels cannot be so tight that you're trying to get every little wiggle. And surviving the bull market, that's a really interesting way. I've never heard that. I think it's super interesting because it's totally true. And I think that being too cautious and killing yourself with the paper cuts is just as big a problem for long-term performance as taking a drawdown in like a bear market. So yeah, I mean, I think that's a really interesting point that you made.
Cool. Yeah, maybe we'll have some more to say that on, or more to say to that on future podcasts, talking about the rest of the team. But kind of wrapping up here, perhaps indicator wise, like we talked about broadly, kind of momentum still coming into this year, suggesting a general risk on posture, domestic equities, commodities at the top of our leaderboards here, expecting some type of turnaround. Kind of once we get that trend, we do expect momentum to self-correct and latch on to those leaders, hopefully mean reverting from last year to not be the worst performing factor. And any other updates that we have on our momentum strategies, thoughts like this, if you're interested, we do put these in daily equity reports located on our research platform. Also, media outlets, Twitter is another one that we've been more active on lately. So we'll make sure to share you our thoughts about this, let you know things that are moving into our momentum strategies as well as we go out into this year. Now, something to watch. Last point I promise here is about value becoming momentum. That's a really interesting concept. Hasn't happened a ton, of course, in the past probably 5 to 8 years, I would say, at least. So kind of value working into momentum, that'll be something to watch. And as we go out through the rest of the year, we'll make sure to keep you abreast of those updates. So John, barring any last comments, thanks for hopping on this week. I think this was really useful and a fun conversation. To those listening via podcast audio, we appreciate. If you're on YouTube, thank you very much. We will do our best. If you ever have questions, reach out to us, email or phone. And barring that, we hope you have a nice weekend.